Hey everybody, it's Brandon at the Insurance Pro Blog, and today I want to talk about a subject that is a little controversial. It's the notion that those who are young and don't have any need to have death benefit in force really have no business looking at life insurance, specifically whole life insurance or other forms of cash value life insurance, universal life insurance being the other one. And this is something that I honestly used to agree with. The conventional wisdom, your typical advisor would tell you, no, you don't have any business buying life insurance at this point. You don't have any dependents. You don't have any need for the life insurance. So just go out and put money in your IRA, your 401k, wherever it is, save that way. And if you ever have to worry about permanent life insurance, you'll do that when you're older, when you have dependents, when you have a need for death benefit. But there's no reason to spend money on something like that now. And I got on board with that notion, but there's been some reflection lately on the numbers. There's also been some kind of admission to myself about the fact that I didn't take that advice. So why on earth should I suggest you do that? And I want to go through some numbers as well as some things that I've done with my own policies that I'm not so sure would have been possible if I had taken my own advice and waited the sufficient amount of time to have dependents before I went out and bought policies. So the first thing I want to get into is just the numbers. And we'll run through a hypothetical here. So if we have a 25-year-old male who wants to put $5,000 into a whole life insurance policy, by the time he's 60, he should have something in the neighborhood of $472,000 of cash value accumulated. Now, alternatively, if he was going to wait until he was older, maybe had a little more money, maybe was a little more prepared, or maybe just had some more need for death benefit, and he bought that policy at age 35, in order to have the same amount of money in cash value at age 60, that premium needs to be closer to $10,000. Now, I'm sure because we're talking about life insurance, most people are going to assume that's a function of cost. As you get older, life insurance gets more expensive. So the fact that he would be 10 years older means that he'd have to spend more money, double, basically, the amount of money, to get to the same result at age 60. But this really doesn't have anything to do with the cost of life insurance, because these are blended whole life policies that we're designing to maximize the cash buildup feature. So given that fact, the difference in premium needed has virtually nothing to do with the cost of life insurance. Death benefits being held to its lowest possible point, which means, technically speaking, at age 35, he'd be buying a little bit less death benefit than most likely he'd have to buy at age 25. So this isn't a cost of insurance thing. This is simply a compounding issue, which is true of all saving and investment situations. So if we were going to save money in an index fund, but we were talking about the amount of money we would need to save to arrive at the same balance at a later age, we're going to see similar results, needing substantially more money by waiting just 10 years to start the investment plan versus doing it 10 years earlier. Now, you may be looking at this and thinking, well, okay, you have to put more money in, but that's the cost of waiting. At least you can get to the same account balance by the time you're age 60. But I want you to notice something. I want you to pay attention to the amount of money that we're putting into the policy and think about this in terms of the length of time that we're putting that much money into a policy. Starting at age 25 at $5,000, by the time he's age 60, he will have paid $175,000 total in premiums. If he starts at age 35 at $10,000 per year, then by the time he's at age 60, he will pay $250,000 in premiums. He's paid $75,000 more to arrive at the same amount of money at the same age, which means it was far more efficient. He got a much better rate of return with half the dollars going in each year by starting at age 25 versus waiting until age 35, even though we're putting more money in there and ultimately arriving at the same account balance. And it gets worse if we compare this starting at age 45. At that point, he'd have to be paying premiums somewhere in the neighborhood of $23,000 a year in order to arrive at the same account balance, which means $345,000 is the total amount paid up to age 60 to get to the same place. Now it's almost double the amount of money that will ultimately be paid if starting at age 25 at just $5,000 a year. So waiting costs a lot of money, and it's not just about death benefit costs. In fact, it has very little to do with that and everything to do with the power of compounding, which can be harnessed at a much younger age and benefit you substantially if you have a longer time horizon. But since we are talking about life insurance, let's go over death benefit details for just a second. So starting at age 25, the death benefit that accumulates through age 60 is very similar to the death benefit that will have accumulated starting at age 35 or age 45. And again, he arrives at that place with fewer premium dollars going into a whole life policy because he started paying premiums at such a younger age. So yes, the cost of acquiring or establishing the death benefit is higher, but that's not necessarily what's causing the difference in needed premium to arrive at the same cash value balance. Now, personally, I bought my last whole life policy focused on cash accumulation when I was in my mid to late 20s. And at the time, I didn't have any dependents. I was single. I wasn't even dating anybody at the time. I only had to worry about me, myself, and I. But I liked what whole life insurance brought to the table. I saw a path where owning that and accumulating value in a policy was certainly something I wanted to do, in addition to the ones that I had already bought that were much smaller. And so I made that purchase with the intention that this was something that would grow over time to benefit me and the eventual family I would have. I recently took a fairly substantial loan against that policy, the six-figure loan against that policy. And I did it specifically to pursue a certain investment opportunity that was sitting right in front of me. That investment has already paid off a result of about 40% to me. Now, if this had been money sitting in a brokerage account, I would have had to sell the position, account for the capital gains tax that would have been due. And that may have been a strong impediment that delayed me or completely stopped me from pursuing this idea. And if it had been in a retirement account, the access to it would have been off the table. But taking a loan was very efficient. I requested the loan on a Friday and the money was in my account on like a Monday or a Tuesday, which is generally what we find taking place with most high quality insurance companies when a loan request gets submitted. The only real cost I face is the 6% loan interest that will accumulate on the loan. And that is largely offset by the fact that the cash still exists in the policy. It's still growing at the guaranteed interest rate, and I'm still earning dividends on all the cash in my policy. Yes, it's true that this particular whole life policy is a direct recognition contract, but the net change in my dividends payable was $100 or $2. It really wasn't a big deal. But focusing in on just that 6% loan interest for a minute to talk about cost, if you will. So that's certainly less than capital gains tax, even long-term capital gains tax would be. And it's also less than my effective state income tax rate. But I've also already started to pay back some of that loan. It's funny, at first I was holding off because I thought maybe I would do something else with the money, but then it occurred to me that I could just pay off the loan, and if I did end up wanting that money for this other thing, I'd just request another loan, and at the very least defray even further this relatively small cost of borrowing that I'm incurring by having the loan outstanding on the policy. Now, you could show me that if I had taken all the premium dollars that went into this particular whole life policy back when I bought it, which was over 10 years ago, and I had invested that in something like the VFINX, you could show me with backtesting that today, even after paying taxes on a sale, I would have more money, not a lot more money, not life-changingly more money, but I would have more money than I have in current cash surrender value of the whole life policy. But I wouldn't have the opportunity, at least not easily, to leverage that money for a loan, assigning it as collateral, for example, through a policy loan and taking it to go do something else with it. So I would have had to have sold. That has a psychological difference to me and most everybody else. But in addition to that, I also have a fairly significant death benefit outstanding on that policy, which didn't go away. Sure, it was reduced by the loan balance, but there's still a lot of money in death benefits still remaining outstanding because I own that whole life insurance policy. And I assure you, my wife is mighty happy that's the case. So now I've been able to get access to the money, go pursue this other thing that has made me many tens of thousands of dollars richer. All the while, my cash is still sitting in the policy, growing at some rate, and my net cost of borrowing is peanuts, realistically. I've often told people when they wanted to argue about the rate of return of whole life insurance being poor, that's not really the case. They're just not using policies correctly. And quite frankly, I see there being a number of other opportunities in the not so distant future for me to do what I have done here with my policy again, which means it won't take long to completely wipe out any advantage I would have had by passively index investing those premium dollars versus buying a whole life policy. But the other thing that I want to mention in this context is the fact that it's common for me to have a conversation with individuals looking to buy a whole life policy who tell me that they want to get started on this because there's a number of investments that they think they would like to pursue in the not too distant future, and they'd like the cash value in the whole life policy that they could then borrow against to go do those things. Now, if I had bought a policy a year or two ago, I would not be using it to do what I just did. The fact that I've owned this particular policy for over 10 years has put me in a position where taking a loan is no big deal at all. And the obligate infinite banking practitioners usually admit at some point that there was absolutely zero compromise on the idea that starting your own policy for your own self-banking purposes did require a waiting period while you, as Nelson Nash put it, capitalized the bank. So buying a whole life policy when you're young and you really don't have any real need for the death benefit is not a bad thing. And because of the nature of compounding in general, you benefit from the fact that at a younger age, you just don't need as much money going into the policy to have a meaningful result after a decade or two of ownership. I've had a lot of conversations with people who have delayed their purchase of life insurance because they're trying to get things in order. They're trying to wait for the right time. They maybe don't have enough money on hand, at least in their mind, to make it worth buying a policy. But as you can clearly see here, starting with something earlier will be more beneficial than trying to get to the right magical number at some point in the future because you're giving up so much in compounding while you wait. And there's also the fact that you can own more than one life insurance policy. So maybe you start with a lesser amount when you're younger, makes perfect sense. But when you're older and you have more money, then you'd like more money going into a life insurance policy. You just buy another one. Maybe it's another whole life policy. Or maybe this time you buy a universal life insurance policy to diversify your exposure. Whatever, it all works out. I'll even tell you that knowing what I know now, having the last decade plus unfold, there are certain things I would have done differently about this specific life insurance policy that I'm talking about that I made personally. But I can't go back and rearrange what I already did. It has worked out just fine. So while there are things that I could have done a little differently, had I waited to try and find the perfect time, or had I waited until I had a much more identifiable need for the death benefit, I would be in a much less financially strong position than I am today. There's even a chance that had I not committed those dollars when I originally did, I might have found other excuses to never buy the policy in the first place. And that, quite frankly, would have been a huge tragedy.